Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, May 13th, 2024. So as we previewed last week, there were only two significant economic data points that were released last week, and both of those came in below expectations. So we're observing what's been happening since GDP for the first quarter was released on April 25th. We have now a laundry list of data points that have come in below expectations. They include home prices, were actually higher than expectation, which is negative for inflation, but consumer confidence lower than expected, ISM manufacturing lower than expected, ISM services lower than expected, non-farm payrolls lower than expected, and the unemployment rate higher than expected. So it's pretty clear that the Fed rate increases, very aggressive rate increases that started in mid-2022, are starting to have some impact on the economy right when the Federal Reserve is really anguishing over whether or not it is a good time to be cutting rates. So last week, the two data points that we had the initial jobless claims. Those were expected to come in at 210,000. They've been down around the low 210 level. It came in at 231,000, well above expectations. And then the University of Michigan Consumer Sentiment Index, this one was pretty stunning. It was expected to come in at 76, which is close to where it had been running the last several months. It came in at 67.4. That magnitude of miss is highly unusual for this data series. So something we're keeping our eye on, but in total, we will have to admit that since the GDP report on April 25th, economic data has come in much weaker than expected. So even with all that, and this is almost as surprising as that University of Michigan consumer confidence number, is the Atlanta Federal Reserve's expectation for second quarter GDP. So we were touting the fact that over a 6-quarter period, the U.S. economy kept beating expectations, and the number kept coming in much closer to the Atlanta Federal Reserve's estimate. That discontinued during the first quarter. Atlanta Federal Reserve was way higher than the reality. GDP came in at 1.6%. I believe their last estimate was about 3.5%, so they were way too high. Their expectation for the second quarter not only appears really high, but they took it up considerably last week. So their expectation now is the U.S. economy here in the second quarter, 2024, is growing at 4.2%. I would take the under on that, given everything that we've just seen, the litany of economic data that I just have given you over the last 3 weeks that have come in disappointing, would suggest 4.2% is really high. Here are some other indicators. Inflation expectation, actually, it had been ticking up for several months. Last 2 weeks has actually come back down, settled down. It's at 2.34%, so hardly moved as of last week. Then we take a look at what the Fed funds future market is telling us about the future Fed rate increases. So there is a June meeting. It's June 12th is the FOMC announcement. Expectation, almost no chance of a cut. In fact, it's 96.5% chance of the Fed not making a cut. Then, as we always do, we take a look at the end-of-year expectations. And investors have definitely tempered their expectation for cuts. So the odd of no rate cut at all went from 2 weeks ago was only 8.5, moved up somewhat significantly to 11.2%. But the odds of at least 2 rate cuts by the end of the year came in at 55% as of the end of the day Friday, which is down from 62% the prior week. So again, expectations further decrease for Fed cuts here in 2024. So all of this last week, you might think that would be negative for markets, but again, markets are focused on corporate earnings. They're focused on inflation and whether or not the Fed might be able to cut. So I'm not sure. Maybe it's the expectation that inflation may be improving, given the fact that demand is probably slackening at this point. Not sure. But last week, S&P 500 up 1.9%. So year to date, S&P up 10%. Here's the most interesting thing I would say out of the index numbers returns here in the U.S. on a year-to-date basis. 10%, fantastic for the S&P 500. The NASDAQ, which had been by far the leader during 2023, NASDAQ actually, the return year-to-date is below the S&P now. It's up 8.9%, so very strong, but well below the 10% increase by the S&P 500. Additionally, value has been rebounding, coming back. So for the week, just last week, growth was up 1.2% in the U.S., value up 2.2%. So now on a year-to-date basis, value is up 7%, growth is up 5.75%. So it's good for our portfolios. We do favor value. It's good to see value coming back. Now, on the international front, we've been mentioning the fact that international has been performing closer to the U.S., but still below the U.S. on a year-to-date basis. So developed markets, they were up, ex-U.S. was up 1.6% last week. So on a year-to-date basis, up 4.7%. Again, the S&P up 10% over that time period. Emerging markets up almost the same for year-to-date, up 4.68%. But the big winner year-to-date actually has been China, which was up 1.9% last week and now is up 10.7% for the year. Just a really quick blurb on that. Back in March, China made several reforms to their equity markets, which included the restriction or banning of short selling. So if you wanted to bet the stocks were going down, they took that option away from you. They also made some reforms regarding companies doing initial public offerings. So the effort is to bolster confidence ultimately in the Chinese stock market. Certainly has worked. So last week again, China up 1.9%. On a year-to-date basis, up 10.7%. A fixed income last week, sort of a yawner. The 2-year yield was up 4 basis points, 10-year down 2 basis points, almost no movement. The Bloomberg U.S. Aggregate Bond Index up 9 basis points. So year-to-date, that index is a negative 1.97. So let's take a look at the economic data points coming up this week. We have got a number of very important ones as opposed to last week, and they're mostly inflation related. So tomorrow, Tuesday the 14th, we have the PPI and core PPI, important indicators of inflation, producer price index. So the core PPI is expected to come in at 0.2% for the month of April, same as it was for the month of March. But there's expectations that the PPI in total is expected to actually increase to 0.3% month over month in April. It was up only 0.2% month over month in March. Then on Wednesday, this is the big day, CPI, CPI core, and retail sales. So expectations there for the headline CPI, it's expected to be flat month over month at 0.4%. That's what it was in March, 0.4%. Obviously, that would suggest it's running at a 5% annualized rate. I don't see how the Federal Reserve can drop rates when you're running at those levels of inflation. Core inflation, now that's expected to come down a little bit to 0.3% month over month for April. For the month of March, it was up 0.4%. But still, if you annualize that, 3.7, 3.8%, just well above the Federal Reserve's stated 2.0 target. So we also get retail sales on Wednesday. This will be, again, very important for inflation. The expectation is that retail sales were up 0.4% month over month in April. The month of March, it was very hot. It was up 0.7%. So expecting deceleration in retail sales, which again would be good for inflation expectations. Lastly, for this week, housing starts and initial claims later this week, both on Thursday. Housing starts are expected to reaccelerate. It came in at 1.32 million in the month of March, expected to be 1.41 million for the month of April. And initial jobless claims, which surprised to the upside last week at 231,000, that's expected to come back a little bit and come in at 220,000. So That's it for the preview of this week and the review of last week and equity markets, capital markets for last week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.